ET Now Startup Central, India's first and only daily show dedicated to startups and entrepreneurship. I'm Chandra Srikanth, joining you live from India Startup Hub, Bangalore, and we have a power-packed show lined up for you over the next 20 minutes.
And I'm Kumar, coming to you live from ET Now's Mumbai studios. First up, look at all that's making headlines in the world of startups. No Chinese jitters for Alibaba as the company boxed the slowdown trend to beat street estimates post revenues of over $5 billion. Facebook is on course to toppling Google's dominance in Silicon Valley. The social networking giant releases a phenomenal set of quarterly earnings that beat even the most optimistic estimates on Wall Street. Profits crossed the $1 billion mark for the first time. Myntra clocks $800 million in gross merchandise value and is all set to reach the $1 billion mark. We get you a chat with Anand Narayanan, CEO of Myntra, to know what's driving the growth and their plans going forward. Just Dial misses street estimates with its quarterly earnings, posts a 16% drop in consolidated profits. And on our special segment, The 3 Mistakes of My Life, we get you Edcast's CEO talks about his mistakes that others can learn from. And it's Alibaba shining all the way despite the slowdown in the Chinese economy, and analysts themselves expecting a negative quarter in terms of their quarterly earnings. Alibaba has just wiped everything off and posted an incredible quarter of positive earnings, 32% growth in revenues. Isn't it, Chandra?
Alibaba certainly seems to be in the pink of health despite all fears to the contrary. If you just look at the headline numbers, they've posted revenues of $5.3 billion, a jump of 32% year on year, clocking over 400 million active users. And in terms of GMV, which is a metric that Indian e-commerce companies track closely, they've notched up $149 billion in that. Remember, India's biggest company, Flipkart, is targeting a GMV of just a fraction of that number in a couple of years. So that really gives you a scale, a sense of the scale and proportion as far as Alibaba is concerned. Even in terms of mobile, they've seen 70% of user activity coming in from mobile. But to really get you more perspective on these numbers, we have a special guest on the show, Michelle Kim, who leads Internet and Telecoms research for Maybank Kim Eng. Michelle, thank you so much for talking to ET Now. As someone who tracks Alibaba very closely, these numbers would have come as a pleasant surprise to you, above every consensus estimate. What are the drivers?
Alibaba's FY third quarter 16 numbers look very solid, beat consensus by a large margin. It even beat our numbers, which were well above consensus on just about all lines, including revenues as well as operating profit and net profit. I think the key reason why Alibaba was able to beat consensus was on the monetization rate. We're tracking at 2.98%. I think that's well above what consensus was expecting, and I think that's a key contributor.
But you know, are these numbers sustainable? Because in the last few years, the fears around China have been profound. I'm sure a lot of this is coming because of, you know, the holiday season in the last month. They also had their Singles Day sale. But is this sustainable going forward?
Well, usually the macro numbers tend to run ahead of actual numbers that we see on a retail level. Having said that, I mean, when I look at Alibaba's GMV numbers, it did come in a little bit softer than what we're expecting, which means that even though GMV was softer, the company was able to do a better job in terms of monetizing. That's why they were able to beat consensus numbers. So this doesn't really give us a clear indication as to whether we could assess whether on a macro level we see a major slowdown on us. As I said, especially because at a retail level, it tends to lag that of the macro level.
Michelle, this is Krishna coming to you from ET Now's Mumbai studios. You know, 32% is a great growth rate, but it's nowhere close to the kind of 60 or 70% heady growth that Alibaba is used to seeing. You know, if there are one or two issues that you would want the management to clarify, what exactly would they be?
I think what I would like to see more clarity from the management is on their O2O strategy, because as I understand, they will be pulling out of Meituan, Dianping, a merged company, which is the O2O company that Alibaba had invested in before, and instead Alibaba will be looking to invest in other form of O2O outfits. So that's one thing, and the other thing is in terms of how does the management will go about managing new investments, whether they have clear goal in terms of profitability in a composite manner or not.
Finally, Mitchell, the reason why Alibaba holds so much of interest in India is because a lot of the e-commerce companies here take their cues from Alibaba in terms of businesses, business models. They are also an investor in Paytm and Snapdeal. So in terms of broader strategy, do you think India will be a focus going forward? Because a lot of people say that, you know, it's the only bright spot among emerging economies. So in terms of Alibaba's strategy for India, you know, what do you see there going forward?
Yeah, I think I think Alibaba is very forward-thinking and having already invested in India, and I mean I agree. I think India is going to be the new frontier, especially the new big growth market. Having said that, I mean still there's a lot of competition in the e-commerce space in India with more than 5 e-commerce players. So including Amazon of the U.S. So I think it's not all that easy. However, I think I do give credit to Jack Ma for being forward-thinking.
Thanks so much, Michelle, for really putting all those numbers in perspective. So clearly no Chinese jitters for Alibaba. But what else do we have, Krishna? Social media giants that's really posted blockbuster results.
Absolutely. That's the other big story that we're tracking over here. Facebook is on course to toppling Google's dominance in Silicon Valley. The social networking giant released a phenomenal set of quarterly earnings that beat even the most optimistic estimates on Wall Street. So much so that Facebook now looks set to become the biggest tech company in the world. Here is the detailed report.
Facebook is not new to beating expectations, but this one is special. The company has rung in its first billion-dollar quarterly profit. In fact, it has doubled to over $1.5 billion. And another first, revenue surged well beyond the $5 billion mark, with growth in excess of 50%. New advertising formats and improved mobile app drove a sharp rise in ad sales. Facebook now has more than 2.5 million advertisers and is expected to haul in nearly $10 billion in display ad revenue this year, the highest in Silicon Valley by a mile. Facebook has also topped estimates for its number of users, reporting that it saw total monthly active users at about 1.59 billion by the end of the quarter. Add to that another 900 million users on its recent acquisition WhatsApp, 800 million on its own messenger platform, and another 400 million on Instagram. The results also mean that Facebook has now beaten analyst expectations for 10 consecutive quarters.
Away from two international giants to an Indian e-commerce company, Myntra. Now remember, there's been a lot of back and forth on this whole app-only strategy, but Myntra claims that the app-only strategy has paid off for the company. It's clocked $800 million in GMV so far and is on course to hit the $1 billion mark in the next fiscal year. ETNA's Rahul Dama caught up with Myntra CEO Anant Narayanan. Let's listen in.
We have had about a 70% year-on-year growth. We are also probably the largest vertical fashion player in the industry remaining. What's really worked for us, by the way, is just deep partnership with brands, getting our selection right, and then getting our consumer experience right. So the app-only move has helped with consumer experience, and our supply chain is very well integrated, so just the last mile service and the NPS associated with it has also been good. We also have a very high repeat rate. So we have about an 85% repeat rate, which is among the highest in the industry. All these have contributed to both the growth as well as the future growth, which hopefully will come.
You have set an ambitious target, which
Yeah.
you've also reaffirmed time and again,
Yeah.
of hitting the $1 billion mark
Yes.
in GMV
Yes.
by 2016-17.
Yes.
So what really will drive this sort of a growth going
Yeah, so I think there are three things that will drive the growth. The first really is what I would call selection. We're going to make a big push on women, where we actually want to increase the selection that we have for women. The second is international brands. It's about 5% today. We want it to become 15%. And the third is our own private brands, which is Myntra fashion brands. We want to grow their share as well. So those three things on selection will help. The second big thing is really around our product. We want to get a community of engaged fashion users. So we want people to keep coming back to our app independent of buying. That will go from about 12 to about 20 times a month. That will drive the second tranche of growth. The third is we plan to launch a whole slew of fashion value-added services in the last mile. Like alteration, for example, try and buy. So these are things that I think normally a normal player would not do, but we are at a certain scale that we feel like as market leaders we should be doing these things.
All right. I'll come to the brands in a while, but discounts, sequentially the discounts have come down by 6%, I believe.
Yeah.
So would this, how would it pan out going forward? Would you be phasing out discounts because a larger thrust of yours would now be on profitability and
Sure.
unit economics?
Sure. So I think there's no easy answer on discounts. So I don't want to pretend that discounts will go away. I don't think they will. What we want to try and do is to reduce discounting to what I would call a more normal level, very akin to what an offline retailer would do, right? Because even in an offline retail, there's an end of season sale that happens because you switch seasons and fashion goes on sale. We want to try and get to that level.
All right.
So it's no easy answer, but we're going to work on it.
All right. Coming a bit more to dig into your private label brand
Sure.
that you have and the international collaborations that you have, the partnerships you've had. I believe close to 20% of your revenues last year came in from the private
Yes.
brands. So because the margins are also better.
Absolutely.
So, would your larger thrust now be on the private labels
Yes.
going forward?
So absolutely. Our goal is to go from 20 to 30% this year, and that will certainly help with profitability. Also, by the way, more than profitability, I feel we have a unique position to create brands. India is one of the most under-penetrated markets in terms of brands.
So we've had two international companies posting earnings way beyond estimates, but back home, Just Dial put up a disappointing set of quarterly numbers with the stock hitting 52-week lows as well. The company posted a 16% drop in its consolidated net profit on a year-on-year basis. Profits for the quarter, profit after tax for the quarter was down 42%. And to discuss that and take it forward, we have Kumar Krishnamachari, CFO of Just Dial, joining us here on ET Now, Startup Central. Kumar, thank you so much for being with us over here. It's not just about a quarter or so. Your core search business has decelerated over the last 5 quarters. Even paid listings growth was disappointing for the second consecutive quarter. What explains the extending weakness, and are you still hoping for a 20% plus growth by, say, the first quarter of FY17?
Not by Q1. I mean, it's very difficult for us to. The turnaround you should see in Q1. So the upward trend you should start expecting in Q1 onwards, FY17 onwards. Now, it's very simple. We have to expand scale. That's the bottom line. The volumes are going to come from expansion of the sales force and scale. Right now, what we should have been, we should have done this at least a year back. All this expansion, probably we would I would be speaking a different language today. But nevertheless, we have identified what the issue. We dropped the ball on execution as far as scale is concerned. We have already taken corrective action. You should see the impact of those action coming in from Q1 onwards. So it's not that I can do it in turnaround in 1 quarter. It takes time for the sales force to come on board, start producing. So it will take at least a couple of quarters for the impact to really be visible on the numbers, both in actually overall in the volume as well as in the sales growth.
Sir, you've also, spoken about the Search Plus offering before. We know this is ready, but no update on the launch yet. Considering at a time when competitors are snapping at your heels, there is more delay as far as this new offering is concerned. Give us an update on Search Plus.
Ad campaign should start this quarter anytime. The product is ready. We were waiting. We want to make sure that the product is ready for ordinary Indian homemaker to perform transaction on mobile. So we are happy with the product that we have. and you should see us start spending on the advertising this quarter onwards. We still maintain that we are going to spend the 100 crore for the sort of mass communication reach that we're going to start. So we maintain that. That should happen in the next, the whole entire 100 crore will be spent over the next 3-4 quarters.
Kumar Krishnamacharya, CFO of Just Dial, thank you so much for taking time out to be with us here on ET Now Startup Central. Now away from all that and on to the special segment that we have on the show that we call the 3 mistakes of my life. And today we get you Ed Cast's CEO who talks about his mistakes that others can learn from. Take a look.
I'm sure I've made like 300 mistakes, and it would be very hard to actually look at those 300 and say which were the 3 were the biggest. But let me try to answer and pick the 3. I think that the number one mistake is not taking a risk, right? Because as it's rightly said, that you lose every single shot that you don't take. So not taking any risk could be the biggest mistake of your life. So that's number 1. I think number 2 is that we always, if I look back in my life as both as an investor and entrepreneur, I think some of the biggest mistake I've done is underestimating people. Human psychology is always that when we hear new ideas in new people, we are psychologically very skeptical about it, that whether this will work, whether this person can actually deliver. And a lot of time, we give up on opportunities because we underestimate people. I would rather be overestimating side than underestimating. I didn't invest at the right time in Google or in Facebook, just underestimating their potential. But those are some big name examples, and I'm sure everyone has that. I think the third thing is that it's giving back. And that's very important, because whether it's in entrepreneurship or anything in life, the more you give back, the more you receive. And a lot of time we have this wrong notion that, after I'm going to become successful and I have enough wealth, I'm going to start giving back to society. I think that's a very wrong, flawed notion, because that someday never comes. So we need to start working on giving back right from day one. And that's where I created a new non-profit called Code for India, which allows anyone, even in their early 20s, 30s, or even in their teens, to start giving back to society, not by writing checks, but at least volunteering their time and talent. And the more you give back, the more you learn, and more ideas flows through it, more networks that you build. So that is something that I would definitely think, looking back, that the sooner and the earlier you start in your life by giving back, the more you're going to be successful in your life.
I hope you certainly learned a thing or two from Carl Mehta's 3 mistakes. It certainly helped us as well. But moving to the final segment of the day, and the number we are crunching for you today is $46.25 billion. That's the personal net worth of Mark Zuckerberg, which jumped by a few $billion thanks to Facebook's blockbuster results, as a result of which he overtook Oracle chairman Larry Ellison to become the 6th richest man in the world. Certainly a big number there. Krishna, I really wish Mark Zuckerberg decides to divide $46 billion among his over billion users, who are helping him day in and day out gain more average revenue per user on Facebook.
Absolutely, Chandra. I'm one of those, and I'm sure you are as well. But that number, $46.25 billion, is absolutely amazing, especially because at a time like this, Facebook posting a quarter like that says a lot about the company and what it has in store going forward as well. Keep in mind, there is still WhatsApp that is yet to be monetized properly. So that's going to add to it as well. But on that note, we wrap things up here on ET Now Startup Central. Coming up next is Market Watch, so don't go anywhere. Keep it with ET Now.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.